Same car, same dealership, same $487 a month. One of them is building towards something. The other is slowly being taken apart by a decision that felt completely fine on a Tuesday afternoon in a room that smelled like carpet cleaner and new upholstery. That is the thing about a car payment done wrong. It does not announce itself. It just sits there every month, quiet and patient, while the rest of your financial life gets smaller around it. Here's how it starts. Two people, call them driver A and driver B, both 27, both earning $58,000 a year, both walking into a dealership within the same month, looking at the same model, a midsize sedan, well reviewed, good safety ratings, the kind of car that makes sense on paper. The salesperson's name is either Mike or someone who acts exactly like a Mike. He's good at his job. He asks one question early, and the answer to that question determines almost everything that follows. He asks, "What kind of monthly payment are you comfortable with?" Driver B answers. Driver A does not. That is the fork. Driver B says something around $450, $500, and Mike goes to work building a deal around that number. The price of the car, the interest rate, the loan term, the trade-in value of the current vehicle, all of it gets assembled in a back office into a package that lands at $487 a month. It feels reasonable. It is close to what was said. Driver B signs. The car is real. The payment is real. The total cost of that decision, $34,216 over $1,216 over 70 months at 8.9%. APR on a $26,500 vehicle remains invisible, at least for now. Driver A spent 3 weeks before setting foot in the dealership. Not 3 weeks of obsessing, 3 weeks of being deliberate. There is a difference. The spreadsheet has 4 columns. Total car budget, which is not the same as sticker price. Monthly all-in cost, which includes insurance, fuel, maintenance estimate, and registration, not just the loan payment. Loan term target, which is 48 months, because past 48, the interest compounds into something that starts to feel insulting. And exit plan, which is how long before this vehicle is paid off and the cash flow opens back up. Driver A walks in knowing the number is $23,000 out the door, not the sticker. Out the door. The negotiation starts from there. Same car, different universe. The loan term is where most people get quietly rearranged. A 72-month loan exists because it makes expensive things feel affordable. The math is not complicated. Stretch the term, drop the monthly number, collect more interest over time. On a $26,500 vehicle at 8.9% APR, a 48-month loan costs $657 a month, but $5,000, $436 in total interest. A 72-month loan costs $477 a month and $7,800.74 in total interest. The difference is $2,438 paid for the same car. Driver B chose a lower monthly payment and paid more. Driver A chose the shorter term, negotiated the price down first, and paid less. The monthly payment on Driver A's deal is actually higher. The total cost is not. This is a trade-off that the dealership finance office is not particularly motivated to explain. A PR compounds the problem or the advantage, depending on which driver you are. Driver B accepted the rate offered because Mike said it was competitive and the monthly number still felt okay. Driver A came in with a pre-approval from a credit union at 6.4% and used it as leverage. The dealer matched it to keep the deal. On a $23,000 loan over 48 months, the difference between 8.9% and 6.4% is $1,580 in interest paid. That is not a rounding error. That is a car repair fund. That is 4 months of a gym membership and a grocery bill. That is real money that one driver keeps and one driver hands to a lender without ever seeing it leave. Then there is the trade-in. Driver B has a 2018 hatchback with 74,000 miles on it. The dealership offers $8,200. The private market would have paid $11,400. Driver B takes the deal $1,400. Driver B takes the convenience. The $3,200 difference gets folded into the new loan, which means Driver B is now financing $3,200 that was already owned. That is negative equity at the starting line. Driver A sold privately 2 weeks before. It took 4 days on a listing app and one slightly awkward test drive with a stranger in a Patagonia vest. The check was $11,100. That went directly toward the down payment. Driver A arrives at the dealership with cash equity. Driver B arrives with a deficit dressed up as a trade-in credit on a purchase agreement. The insurance line is where the monthly payment mythology fully collapses. Driver B's mental model of the payment is $487. The actual monthly cost of operating the vehicle is different. Full coverage insurance required by the lender on any finance vehicle runs $194 a month. Fuel, $160 based on actual commute distance. Maintenance reserve, $75 a month to cover tires, oil changes, brakes, and the thing that makes a noise in January that turns out to be expensive. Registration amortized monthly, $18. The real number is $934 a month. Driver B thought the car cost $487. It cost $934. Those two numbers do not produce the same life. One of them fits. One of them bleeds. Driver A ran these same numbers before the purchase and made them part of the go or no-go decision. The total monthly transportation budget was set at $780. The loan payment, the insurance, the fuel, the maintenance, the registration. If the all-in number exceeded $780, the car was too much car. The chosen vehicle, slightly lower trim than Driver B's, came in at $743 monthly all-in. That $37 difference per month is $444 per year. Over the loan term, it is $1,776. Invested at modest returns, it is more. These are not dramatic sums. They are the kind of sums that quietly determine whether a person has breathing room or not. The first 90 days after signing are the diagnostic window. Driver B's first 90 days signs up for the highest trim cable package because the payment already happened, and what's one more thing? Lets the emergency fund drift because the budget feels tight and something will come in. Does not set up automatic insurance payment and gets a late fee in month 2. Does not open the maintenance manual. By day 91, the financial footprint of this car is wider than it was on day 1 and still expanding. Driver A's first 90 days. Automates the loan payment for 3 days after payday so it never competes with rent. Sets a separate savings line of $75 a month labeled car maintenance and does not touch it. Calls the insurance company and adjusts the deductible to lower the premium by $22 a month without changing the coverage that matters. Reads the maintenance schedule. Schedules the first oil change. By day 91, the car is a managed expense with a clear end date. It is not a presence in the budget. It is a line item with a timeline. Same car, same $487 average in the general vicinity of what both are paying. Different insurance rates, different loan terms, different total interest, different trade-in approach, different mental model of what the payment actually is. And from all of those differences, 2 entirely different cash flow situations for the next 4 to 6 years of their lives. One driver has flexibility, one driver has a car and not much else. The question worth sitting with before walking into any dealership is not what monthly payment can you handle. It is what does the full picture cost, for how long, and what does it leave you when it is over. So here are the rules, not suggestions, not general awareness. Rules with edges on them, the kind that keep a car purchase from quietly reorganizing your financial life in the wrong direction. The first rule is credit before the lot. Before you set foot anywhere near a dealership, you pull your credit report. All 3 bureaus. You are looking for errors, for anything sitting in collections that you forgot about, for a credit utilization ratio that is dragging your score below where it should be. A 40-point difference in your credit score can mean a 2-point difference in your APR. On a $25,000 loan over 48 months, 2 points is roughly $1,100. That is not a trivial number. If your score needs work, you wait. You pay down a card, you dispute the error, you get the pre-approval from a credit union or a community bank before you negotiate anything. You walk in as a cash buyer who has already arranged financing. That changes the entire dynamic of what happens next. The second rule is out the door price only. The sticker price is a starting point for the dealer. The monthly payment is a tool for the dealer. The out the door price is the only number that belongs to you. Out the door means the vehicle price plus taxes, title, registration, and any fees the dealer adds divided by nothing. It is the total you will have spent when you drive away. You establish that number in advance. You negotiate that number and only that number until it is settled. Then, and only then, do you discuss financing. The dealer will try to combine these conversations. They will say things like, "We can get you into this for $480 a month," which tells you nothing about the actual price of the car. You separate them every single time. The third rule is 48 months maximum. There is no loan term past 48 months that exists for your benefit. 60 months, 72, 84. These terms were engineered to make expensive vehicles feel accessible while extracting thousands in additional interest. If the vehicle you want requires a 72-month loan to fit the monthly budget, it is not a budget problem, it is a vehicle problem. The car is too much car. You go down a trim level, you go to a slightly older model year, you increase the down payment, you do not solve a price problem with a time problem because time is the most expensive ingredient in the interest calculation. The fourth rule is depreciation math runs before you sign. A new vehicle loses somewhere between 15% and 25% of its value in the first year. By year 3, it has often lost 40% to 50%. If your loan amortizes slowly, which longer terms do, you can spend the first 24 months underwater, meaning you owe more than the car is worth. If anything happens in that window, a totaled vehicle, a job change, a need to sell, you are paying the lender for a car you no longer have. The protection is a meaningful down payment, ideally 20%, a short term, and a clear-eyed look at where your loan balance sits relative to the vehicle's depreciation curve in month 1. Run that math. It takes 15 minutes. It is not optional. Fifth rule is add-ons get declined by default. The finance office is a second negotiation dressed up as paperwork, extended warranties, gap insurance sold at triple the bank rate, paint protection, tire and wheel packages, credit life insurance. These products exist because the margin on them is significant. Some of them are not without value. Gap insurance on a vehicle you are financing with less than 20% down is a legitimate consideration, but you buy it through your auto insurer for a fraction of what the dealer charges. You do not buy it in the finance office under time pressure on a Tuesday night. The rule is simple. Every add-on is declined. If you later determine one is worth it, you source it independently. The sixth rule is the payment strategy goes on paper before the loan starts. There are 2 moves here and you pick one. The first is bi-weekly payments. Instead of 12 monthly payments per year, you make 26 half payments. That equals 13 full payments annually. One extra payment per year, applied entirely to principal, shortens a 48-month loan by roughly 3 to 4 months and reduces total interest. The second move is a fixed extra principal payment each month, even $50, designated as principal only, not toward future payments. Both of these strategies work. The one that works is the one you automate the day the loan starts, not the one you plan to do when you have extra money, because extra money has a way of becoming something else before you get around to it. The seventh rule is a contingency plan that exists before you need it. A car loan is a 48-month obligation against an income that can change. The emergency fund is not just for medical expenses and furnace repairs. It is your loan survival fund. 3 months of car payments, minimum, sits in a separate account before you drive the vehicle off the lot. If a job ends, that fund buys you 90 days to find another one without missing a payment, without a late mark on your credit report, without panic driving the next decision. The loan can survive life events if you planned for life events. It cannot survive them if you assumed life would remain stable for 4 straight years because it had been stable recently. These rules are not complicated. That is the point. The car buying process is designed to create cognitive load, time pressure, excitement, social performance, a stranger named Mike who is very good at his job. The rules exist to run before all of that starts, so that when you are in the room, the decisions are already mostly made. You are not negotiating from curiosity or instinct. You are executing a plan that was built when no one was watching and nothing was on the line. So before your next purchase, pick one rule from this list. Just one. If your credit needs work, that one. If you have never calculated an out-the-door price, that one. If you have never mapped your loan balance against a depreciation curve, 15 minutes on a spreadsheet, and that one is done. Then come back here and tell us in the comments which rule you are implementing and why. Not the one that sounds right in theory, the one that changes something specific about how you will actually walk into a dealership. That is a version worth sharing.